a good amount of EBITDA. EBITDA is like earnings before income tax, depreciation, and amortization, then they should have a higher stock price. But that's not always the case, because sometimes decisions are based solely on maximizing returns and minimizing risks, as humans have done forever. And we try to see which or where we can create the maximum amount of value. So in reality, investors are human and subject to cognitive biases and emotional influences that can lead to suboptimal decisions, right? So behavioral finance is all about understanding these biases and influences and keeping them on check to make better investment decisions, and for you to avoid making costly mistakes that would cost you a lot of money in your trades, in your investments. So when we talk about cognitive biases, right, there are a few cognitive biases which normally kind of take precedence when it comes to behavioral finance. And when we talk about cognitive biases are nothing but a systematic pattern of deviation from rational decision making. So in a way, what I mean is that you do know, say, you do know that a company is not doing well. You do know that maybe that company is kind of approaching bankruptcy, but say agree to make some extra money. Say your decision that there will be a kind of a spurt where you can make some extra money, kind of pushes you to make a decision to invest. Now that is where you're cognitive biased, right? So understanding and recognizing these biases is like very crucial for investors so that they make more rational and informed decisions. So this workshop today is about the fact that by being aware of these biases, you can take steps to mitigate their influence and develop better and more efficient investment strategies, right? So we talk about cognitive biases. So the types of cognitive biases that kind of affect investors the most are overconfidence, the confirmation bias, anchoring bias, loss aversion, hindsight, and availability heuristic. So we'll go into each of these to understand what these mean so that we are better suited to not make these mistakes. So we are better suited to kind of understand when we are showing these biases, so that at the end of the day, we are better investors. And at the end of the day, we make better choices and have better returns. So when we talk about anchoring bias, it basically means the tendency to rely too heavily on the first piece of information that you've received when making decisions. So basically, you're anchoring your decisions on a few data points and not looking at the entire whole picture, not looking at the bigger picture. So for an example, an investor may be anchored to a stock's previous high price and fail to consider new information that suggests that the stock is overvalued. So like, for example, think about a company, say, which had a high price of $500 per share, right? And right now the share price is, say, around $250. Now, as an investor, you think that, oh, that's a bargain. I could buy this stock at $250 because it will go up till $500 because it has already reached $500 in its lifetime. Now, the problem is that you're not taking into account the fact that even 250 might be an overvaluation for that stock. Maybe then in the new reality, the company is not doing that well. Maybe it will never reach $500 a share. Maybe the new reality is that it should be priced at 200 and right now it is at 250. So if you buy it at 250, it eventually will go down to $200, wherein per share, you will lose around $50. So, so anchoring can lead you to buy or hold stocks at inflated price, and which might result in a very suboptimal investment decision, which might lead you to have considerable losses in your portfolio. The second is about confirmation bias, right? What it means is basically the fact that the tendency to seek out, interpret, and remember information that confirms your existing belief or hypothesis while totally ignoring or dismissing contradictory information is called confirmation bias, which in a sense or in a way means that somewhere in the back of your mind, you want to buy that stock. You want to buy those shares, or you want to buy that mutual fund, and you're just looking at data points which suggest that yes, you should go ahead and buy. So somewhere in your brain, you have kind of made the decision to buy. You're just looking at signals to confirm that decision for you. And the impact of this can be huge, right? Like, it can lead to overconfidence in your investment decision, which would definitely lead to missed opportunities, or you might be holding on to losing positions for too long, right? Like, for example, you might be thinking that one day this share price is going to come back. One day, uh, you know it's gonna get back to its former price when I'm gonna sell. So you keep on holding a loss-making stock for too long, which results in a very, very suboptimal returns for you and your portfolio. The third is overconfidence bias, right? What it means is that it's a human tendency to overestimate one's abilities, knowledge, or the accuracy of one's beliefs. Like, say, for example, we spoke about, you know, like the qualitative and quantitative aspects of decision making, right? So maybe the quantitative aspect is telling you something, and you're really great at math and really great at like getting to a share price, and you feel like, yes, it's telling me to buy, and absolutely I should go ahead and buy. And you are overconfident that you are so good at math that it can't be wrong, and you should definitely make a lot of money on that decision, right? But what you have done is you have failed to take into account the qualitative aspects, and which might be pointing in exactly the opposite direction. So overconfidence can lead you to take on too much risk. It can make you take impulsive decisions. It might lead you to not diversify your holdings, which will ultimately again lead you to just getting suboptimal returns in your portfolio, which would ultimately mean that, yeah, you are far away from your goal of how much money you wanted to make in the market. The next is loss aversion bias. So what is loss aversion bias? It's just the tendency to feel the pain of losses more acutely than the pleasure of gains, and that leads you to not take trades when you should be, and, like, say, for example, leads you to sell when you should not be. So, like, for example, as an investor, you may be holding on to a losing position for too long in an attempt to avoid realizing the loss. You might be thinking, like we just discussed just now, right, that it's gonna come back. It's definitely gonna, the stock's gonna perform, and that belief in you is coming from a place where you're just being averse to loss making. You're just thinking, uh, somewhere down the line, this price is going to come back, and then I'm going to have a profit. So I'm not going to sell for a loss. And that's exactly what's called loss aversion bias. So loss aversion can lead to suboptimal decision making. or it can also lead to being overly risk averse in pursuit of avoiding losses. Now, both of these are very harmful for you and your portfolio, and you should definitely look out that when like life is all about taking the hard choices, right? Life is all uh, about taking decisions and proving them right. Uh, so just look out that you when you're trading that you are not showing this kind of a bias. So now we have understood these biases, right? And right now, what we are gonna think about is what are the strategies for overcoming these behavioral biases? What are the strategies that you can do as an individual investor, as in a market, which should help you overcome these behavioral biases while you're out there trading? So the first is awareness, right? Like we have been speaking for so long, like recognizing and understanding your own biases is very important. When you're doing something like, say, for example, holding on to a loss-making stock, ask yourself, am I showing loss aversion bias? So identify the cognitive biases and emotional influences that tend to affect your investment decisions, and understand how these biases manifest themselves in your thought process and decision making, and continuously monitor yourself. Like whenever you're doing something, whenever you're taking a decision, ask yourself, am I showing one of the biases? Am I doing something which is telling me the opposite, right? So the second is systematic decision making. I think one of the things that have worked really well for me is to follow a structured process for evaluating investments, right? So you develop a standardized objective process for analyzing and evaluating investment opportunities. You prepare checklists, decision trees, or other decision-making frameworks, which ensures a consistent and disciplined approach. And you rely on data, and a lot of data. And I cannot tell you enough about data. I think at Wharton we are huge on data. So I would say that rely on quantitative data, fundamental analysis, objective criteria, rather than just thinking about your gut feelings or intuitions. The third would be emotion management. So you should definitely implement and have risk management strategies, such as, what's the amount that I'm going to invest? What is my stop loss? Right? We spoke about stop loss in the last workshop, right? Um, what are how are ways that you can practice mindfulness and meditation to cultivate emotional awareness and self-regulation, right? And I think one of the things that have worked actually pretty well for me has been to keep a trading journal. So whenever you make a trade, just write it down somewhere. It's not only going to help you be more disciplined towards your investing approach, but it will also help you when you are, say, filing your taxes, when you are calculating your profits or calculating your losses. It kind of um, disciplines you to identify patterns of emotional decision making, which, in my opinion, I think it has helped me a lot to be a much more disciplined investor in the market. And of course, seek guidance from a mentor. Talk to them about how you can stay disciplined, you can be a better investor. So when we talk about emotional influences, there are only three kinds of emotional influences on trading. And while you're trading, I would say keep a check on these three, then you're perfect to go. But the problem is, and psychology says that these three are so ingrained in us as human beings that it's very difficult. You'd have to have monk-like Zen to have control over these three: fear, greed, and regret. Fear would be like, for example, an investor may sell at their positions prematurely, uh, thinking about what if we have losses. Even when your quantitative uh, decision making says that the long-term prospects of the investment are really great. So Fear can lead to panic selling, which means that you'll get more losses in your hand and you'd miss out on potential gains. Uh, and that's something that's going to influence your trading heavily. Greed, you hold on to a position much longer than you thought you would, because like we had spoken about this before, um, you should have a target. Like, I want to make 15% profit. And when you hit your 15% profit mark, you should just exit the market, right? Because the market is irrational, right? It can change any moment. So a stock that's going up today can be going down tomorrow. So if you're holding onto a position for too long in the hope of like maximizing your gains to the utmost, uh, maybe it'll just turn, and the amount of profits that you had might turn into the amount of losses, right? The greed can result into failing to take profits, and it can expose yourself to significant losses when the market starts correcting itself. And the last would be regret, right? For example, like, you might be holding on to a position for too long to avoid the regret of realizing a loss, or you might be selling a winning position too early, saying that, oh, what if it went down? Anomitra kind of told me that the market is irrational and it turns. What if the market turns and I sell? And you sell a winning position too early, and you later see that the stock has gone up more. So you actually could have made much more profits than you did. So regret can also lead to suboptimal decision making, and as investors may make choices based on the desire to avoid feeling regretful. So don't do that. I think these three are the emotions that you need to keep a check on, and I think if you could check on these three, uh, although you'd need monk-like Zen to have a control on these three, but if you could, then you are by far one of the best investors that the world has ever seen. So we spoke about developing a disciplined investment approach, but then the questions comes, how do I develop a disciplined investment approach, right? Uh, what entails being disciplined? So being disciplined involves establishing a structured framework for decision making and adhering to it consistently. So the first thing to do is to establish a sound investment philosophy and strategy. So define your investment objectives, define your time horizon, define your risk tolerance. So now you know what your investment objectives are. Develop a clear investment philosophy that aligns with your goals and values and what you want that to be, right? The second would be to implement a rules-based approach to decision making. So you develop a set of clearly defined rules and criteria for making investment decisions, such as, like, for example, what are your entry points? What are your exit points? What's your position sizing? What's the kind of diversification you want in your portfolio, right? The third would be to set clear investment goals and risk tolerance levels. Uh, like, what are your goals? Like I said, like 15% is my goal. I want to have 15% return on my capital. So as soon as I reach 15% profits on my investments, I'm going to exit them, right? So set clear investment goals and risk tolerance levels, because that's going to help you become much more disciplined towards investing. And that's going to make you much more eligible, or much more probable to get better returns in the market. So align your investment decisions with your goals and risk tolerance to avoid taking on excessive or inappropriate risk. I always say at the end, it's about maintaining discipline, right? So regular self-evaluation and monitoring of biases. So conduct periodic self-assessments. Look at your journal. Look at the journal to figure out where you went wrong, why you went wrong. Review your investment decisions. Like, think about which are the stocks that I made losses on and why I made losses on them. You look at which other stocks I made a lot of profit on, and why did I make a profit on them? So this continuous learning and adaptation would help you to stay up to date with the latest developments. With it will help you to kind of understand what you did well, what you didn't do well, and then structure your thought process in a way that you continuously start doing well. I'd say the other thing would be to be willing to adapt your investment approach as new information or insights become available, because the market is dynamic, right? It's not static. The market is moving at every point of time. So what you know today might not be true tomorrow, and what you know tomorrow might not be true day after. So you have to continuously adapt your investment approach to the new information that's coming into the market and the way the market is reacting to it. And the last would be to embrace a growth mindset and view setbacks as mistakes. So don't be too hard on yourself, right? Uh, and just be as disciplined as you can as a trader.